Hi, everyone. Welcome to the Hotel News Now podcast. I'm news editor Sean McCracken here with Peachtree Group's Greg Friedman. Greg, how you doing today?
I'm doing good. Thanks for having me today, Sean.
So, Greg, obviously, Peachtree does a lot in the hotel industry. Basically, everything a hotel company can do, it feels like. But lending is a big piece of the puzzle for you guys. As we head into the new year, I'm curious, as somebody who's kind of tuned into the space, how would you describe the general lending environment right now?
Yeah. So when you look at, lending today across commercial real estate, you look at it across hotels, the market continues to remain, dislocated in the sense that, the regional banks, the community banks, the national banks, make up about 50% of, the hotel lending market. And banks in general, even, post-election, banks in general are still, not able to lend at the same levels that they once could across hotel properties and other commercial real estate properties. And
Mhm.
given that, for, especially for hotel assets that are going through some type of transition, there's still a lack of, capital. When I say a lack of capital, really the cheaper capital available, for those projects that are going through transitions. And when I say transitions, really being, construction or renovation projects and things like that. So with that said, if you've got a stabilized property, a property that's got, great in place cash flows, there's a lot of debt options that are available for you. If you're trying to finance a project that's construction or renovation driven or has disruption to cash flows due to something happening within the submarket or within the property, it's much more challenging to finance those projects today compared to what you would have seen, potentially post-pandemic. With all that being said, there is capital available, which is, a good part of it. But the capital available, no matter if the property is stabilized or no matter if this property is going through that transition, as I mentioned, is going to be at a substantially higher interest rate than what we saw, pre-2022, just given how much higher interest rates are today compared to where we were pre-2022.
Yeah. And you bring up the interest rates. Obviously, everybody is feeling better directionally about interest rates, but it seems like still a bit elevated. How do you foresee that playing out in 2025?
So my personal feeling, and I'll just give you a high level, I expect interest rates to stay, much higher for longer. So I think rates, when you look at the federal funds rate, which, correlates to SOFR, or if you're looking at, long-term rates, which, typically, correlate to the 10-year treasury rate and so forth, in both cases, I expect those rates to remain much more elevated compared to what we saw, in that decade pre-2022. So when you go back, pre-2022, for that 10 to 12 year period, the federal funds rate averaged closer to 75 to 100 basis points. I expect that the federal funds rate is going to settle somewhere probably in the mid threes. And I expect, when you look at the 10-year treasury rate, which is really more correlated to, where long-term rates typically will end up pricing out at, I expect the 10-year to remain above 4%. Today it's at 4.4%. And in that decade pre-2022, for that 10 to 12 year period pre-2022, it averaged closer to, 2.2%. So the the 10-year treasury today is double where it was. The federal funds rate I expect it to settle somewhere where it's going to be 3.5 times higher. And that's going to, ultimately cause interest rates, if you're borrowing short-term, or short-term loans or borrowing capital, on a longer-term basis. In both cases, your interest rates are going to remain much more elevated compared to what you were paying, not only pre-pandemic, but even, pre-2022. So effectively, we're back in a, pre-great financial crisis market because the 10-year, the federal funds rate is closer to that environment today.
So if that's where we expect things to normalize on kind of the cost of debt, how about the availability? I mean, you were mentioning a lot of banks are still on the sidelines. Do we expect a kind of normalized environment to have fewer lenders or fewer the traditional lenders at least?
Yeah, so I think just banks in general are broken. So even with less regulatory pressure, I do expect we're going to continue to see banks unable to lend at the levels that we saw, pre-pandemic, or even the levels we saw, pre-Great Financial Crisis. So I think some of the traditional lenders are not going to be available. But with that said, I think you're going to see private lenders, so firms like Peachtree, where we're doing a lot of private credit and doing a lot of financing, is going to fill that void. And so I think capital will be available, but you're going to find that the capital that is available is going to be, much more expensive. So it's going to typically have a little bit higher spreads than what a traditional bank or some of the other cheaper sources of capital. But there is going to be capital available. And the good thing for, most hotel owners is the capital that comes from a group like us, being Peachtree. We're able to be more constructive, more thoughtful about how we provide loans, so we can really tailor something that makes sense for hotel owners, given the fact that we really understand the business, we understand the challenges of the industry. So I think you will see a lot of capital available. And if I was a borrower looking to finance a new hotel project or acquire a hotel project, I'd be focused on working with groups like us, being Peachtree, that has a great understanding of the hotel industry, but more importantly, has a lot of capital available to lend. So.
Yeah, and obviously you guys were one of the early movers in the type of, private lending space you operate in. It seems like in the past, couple of years, really, there's been more and more entrance into that space. I'm wondering from your perspective, I mean, I'm sure you'd love to be the only one doing it, but do you feel like there's room for growth there? There's room for more of these private lender players?
I think there's definitely always room to a certain degree, because there is a huge void, left in the market just by some of the traditional lenders, as we talked about, that aren't lending. I also think you're going to find that some of these groups, these new groups that have, come into doing private credit or providing lending across hotels and commercial real estate, because we do lend to all commercial real estate property types, even beyond hotels. And one thing I've noticed is there is a lot of competition, and a lot of that competition is struggling to actually to get capital out. And part of the reason they're struggling to actually be able to make loans is they don't have the infrastructure to actually service these loans. They don't have the infrastructure to go, underwrite and, originate loans. They don't really understand, the underlying business models and the underlying, what's really happening with these different borrowers. And so ultimately, it looks to be a very attractive place to play into private credit across commercial real estate and hotels. But I think you're going to find that, a lot of these groups will end up, deciding to move on to other investment opportunities, and it will, I think you'll see some consolidation, or some of these groups that will end up fizzling out over the next, 24 months. So, you are hitting to a level of saturation with some of these other private lenders.
Yeah. And I mean, like any segment of any business, there's a maturation process there, right?
That's right.
So, in general, what are your expectations for 2025? Do you think the environment is going to be similar to what we're already discussing when we get to the end of next year?
I think it's going to be somewhat similar to what we're talking about. I expect that 2025 on just the business front is going to be really good. I think having the new administration come into office, they're obviously going to be very, they're going to put in a lot of policies that are going to be, very, business friendly. They're going to put in a lot of policies that are going to help probably, drive demand for lodging, which should be a benefit for everyone, listening, because, everyone's invested to the hospitality space or hotel space. So I think you're going to see, at the asset level, great performance. I think from a perspective of being able to find capital on the debt side or the equity side, I think you're going to find that more and more people are going to be more risk on, because we're going to have a much more business friendly environment in general. And that, risk on environment is going to end up feeding the ability to find more capital for both equity. So if you're looking to, develop or acquire a hotel, you're going to have more options to partner with different groups. If you're looking for capital to refinance, recapitalize, to acquire or develop, hotel assets, I think you're going to find a lot of different unique options because, everyone's going to be flush with capital, and there's already a lot of liquidity still in the system that's on the sidelines that's looking for places to invest. So I think in general, I think we're headed to be in a really good place on, across the hotel space from a capital markets perspective, as well as at the asset level.
So correct me if I'm wrong, but if I'm, understanding what you're saying, it feels like the construction lending space in particular, you expect to improve, but not from improvements from the folks that were typically construction lenders, right? Like the regional banks of the world that usually filled that space. You think that the kind of new entrants, the private lending space might fill that void.
That's right. You'll definitely see some pickup from some of the, regional banks and the community banks willing to provide construction financing in 2025 versus what you saw in 2024. You're not going to see, I don't think it's going to be super material compared to what's happening, but what I think you'll find is you'll find a lot of groups like Peachtree that are willing to provide construction financing. And as part of our organization, we have we're a large first mortgage lender for new construction projects, but we also do commercial property assessed clean energy loans. And that's a program that's been growing, these C-PACE loans, to help capitalize and finance new development projects. And you'll see, like in a lot of cases, we're partnering with banks and other financial institutions where we provide the C-PACE loan and they provide the senior loan. And in other cases, we're providing both the C-PACE and the senior loan as a way to, minimize the equity need for developers. So I think you're going to see a lot of unique structures like that in order to help provide the capital for someone to start a new project. Because as you know, like development in general is down pretty dramatically from historic averages. And so I expect that 2025, you're going to start to see that, the lack of new supply is going to somewhat stabilize, where you're not going to see a lot of projects, you're going to probably start to see a lot of new projects actually start in 2025 or 2026 because they're going to be able to get capitalized in 2025.
Yeah, which I guess is good news if you're a developer. It's bad news for everybody who's really been enjoying this historically low supply environment stretch that we've had recently.
That's right. But we're not going back to where we were pre-great financial crisis. Because you think about 2007, 8, 9, we had a huge explosion of supply that was growing at call it, 2x the historic, average of supply delivery. And right now, I think we're like 30 to 40% below historic averages. And so, I expect that when you look, in 2025, 2026, 2027, you're going to see that demand is going to probably continue to match, any supply growth, or it's going to even exceed it. And so I'm not too, uncomfortable about what's happening at the asset level and the demand supply fundamentals. I think the hotel space comparatively, when you look at all of commercial real estate, I think it's one of the more attractive places to invest into today, just given the fact that there hasn't been a lot of new supply built since the pandemic. And it's, and we're probably going to have several more years in front of us where supply is going to, fall below demand growth. So, which is a positive for our industry.
So, the other side of that coin too is, we talk about renovation financing. It's obviously this is an interesting point in the history of the industry because, we had this stretch where the brands were so remarkably flexible with owners, and it seems like that moment has passed, and there's a lot more brands kind of drawing the line on pips. Like, is there the money out there to do the work that the brands want hotel owners to do right now?
Yeah, so I think you're definitely seeing a pickup of that capital that's available to finance renovation projects. You're seeing a lot of, for instance, us at Peachtree, we're providing a lot of, capital for refinancing existing loans, where we're providing additional capital for renovations, and we're providing a lot of acquisition loans where someone's acquiring an asset because the seller of that asset needs to do a PIP. and they're not willing to spend the money on the PIP, so they're being forced to sell the asset, and the new buyer is going to perform that renovation, and we're helping capitalize and finance not only the acquisition but the renovation as well. So I expect to see that being a huge catalyst, because to your point, CapEx spend across the hotel business is down like 50% since 2020. So it's, it definitely needs to, you're definitely going to see an increase, because the brand's ability to tolerate a lot of these hotels that have not gone through renovations over the last several years that we're supposed to, is I think their patience are growing pretty thin, and they're going to be forcing a lot of these owners to either renovate, or they're going to, ultimately be forced to sell the asset, or find some other way to capitalize those renovations.
Yeah. So not to put too fine of a point on this conversation, but it seems like one of the big takeaways I'm getting from this is that obviously 25 will be at least marginally to maybe significantly better for borrowers than 24. But it seems like the people who are able and willing to be a bit more creative on that side are the ones who are going to come out the big winners, right?
That's right. I think if you're wanting and you're willing to move forward on projects, I think you're going to be able to find the capital in 2025. I think if if you're able to be somewhat creative, as you mentioned, I think you're going to have, you're probably going to find a much more creative structure, just given there's a lot of, creativity in the marketplace. If it's blending C-PACE loans with, first mortgage construction loans to, finance new development projects, or finding ways to utilize, EB5, because EB5 is another program that's starting to come back. We actually have a team internally that does EB5 as well. And that's another way to help capitalize new construction projects. And in general, I just think we're going to be in a more risk-on environment, which we've all seen over the last, couple of weeks, as the new administration, as everyone's getting more excited about the new administration, and that having that more risk-on environment is going to allow for, more liquidity, into the system, which is going to find its way to hotels as well as, all of commercial real estate.
So, Greg, I think this has been a fantastic conversation. I asked you everything I wanted to. You got any final words of wisdom for any of our listeners out there?
I think my final words would be that this is probably one of the, 2025 should be one of the better years for the hotel industry. It should be one of the better years if you're, looking to make investments, because, I think the market, from a standpoint of just being more stable and able to execute in a very efficient manner, you're going to find that to be the case in 2025. Not to mention, I think we'll have just hopefully a thriving economy, and that's my expectations with the new administration and potentially some of the new tax policies and so forth. So it should be pretty exciting to be in business in 2025.
Well, thanks so much for the conversation and the time, Greg.
Thank you.
Hi, I'm STR's Isaac Colazo.
And I'm co-stars Jan Freitag. And together we are the data geeks behind Tell Me More, a hospitality data podcast on the Hotel News Now podcast network.
Every month, we bring you a fresh take on the latest hotel data, insights into the travel trends behind that performance, and the big picture topics you should be thinking about.
And we also don't mind getting into some good-natured disagreement from time to time. Hey, when Isaac and I start talking data together, anything can happen. And it usually does.
Find us on hotelnewsnow.com and subscribe to the podcast on Apple Podcasts, Spotify, or wherever you like to listen. Search for Hotel News Now, and thank you for listening.
This episode of the Hotel News Now podcast was recorded on December 15th, 2024, and edited by me, Sean McCracken. Visit hotelnewsnow.com for the latest news, and if you've enjoyed this or any of our podcasts, make sure to rate and review on your podcast platform of choice. Thanks for listening.